Welcome to Convince Me in 15 Minutes. This podcast will introduce you to concepts, theories, and philosophies in the world of finance, investing, and wealth management explained in 15 minutes. Your guides are Keith Thompson and Luke Tawas. We are thrilled to have Brian Chingono on the show today. Prior to joining Verdad as the Director of Quantitative Research, Brian worked at Dimensional Fund Advisors and Credit Suisse. He has an AB from Harvard College and his MBA with honors from the University of Chicago Booth School. Luke, I am sorry that I didn't get somebody with better academic credentials for the show today. Brian, that is quite the resume. Thanks so much for joining us. So with that, Brian, why don't you tell us what you're here to do today?
Okay. It's an honor to be here with you, Keith and Luke. Thank you so much for having me. So my name is Brian Chingono. I'm a partner and director of quantitative research at Verdad Advisors. And I'm here to convince you that international markets offer more bang for your buck in terms of profitability and also in terms of value. Financial theory suggests that there are two ways to outperform the market. One way is by purchasing a stream of income at a substantial discount. You can think of this essentially as your standard value investing. A second way to outperform the market would be to pay the market price for a stream of income that grows faster than expected. And as you can see on the slide, we've essentially summarized that into the classic valuation equation, where your return is equal to the sum of future profits divided by the price today. And as you can see, there really are only two levers to pull. Either you pay a cheaper price for those future profits, a la value, or you pay a market price for profits that are going to grow faster than expected. Both of these have drawbacks, however. In terms of the growth approach, empirical research shows that growth is very difficult to forecast far into the future, and also growth does not persist. So a classic paper that was written by Chan, Karseki, and Lakonishek in 2002 essentially looks at the lack of persistence in earnings growth by measuring the companies that have grown above median in terms of earnings over the past year and seeing what proportion of those above median earnings growth companies continue to remain above median over the next 1, 2, 3, all the way up to 5 years. As it turns out, the probability of remaining above median for any number of years in a row is very close to a coin flip. So by construction, 50% of companies are above median over the past year. And then in terms of for 2 years in a row, only 25% of companies are above median for 2 years in a row, similar to the chances of flipping heads twice in a row. And then similarly for 3 years in a row, only about 12.5% of companies have above median earnings growth for 3 years in a row, similar to the probability of flipping tails 3 times in a row. So earnings growth is not persistent beyond random chance. And that's pretty well documented in the academic research. And then on the value side, which has been very well documented, and the value premium is quite robust over long periods of time. The drawback, obviously, with value is that cheap assets can remain cheap for extended periods of time, as documented in Farmer and French's 2018 paper on volatility lessons. So one antidote we would propose to both of these challenges is what is described in Robert Novi-Marx's 2010 paper on gross profitability. While earnings growth is not persistent over time, what does persist is productivity. Right? So productivity being measured as the amount of profits that are generated by a firm's assets. And what you find is that over time, companies that are highly productive generally remain highly productive over the next 2, 3, 4, 5 years. And that persistence of productivity is what leads highly productive firms to outperform over time, especially when they're purchased at low valuations. So as you can see from the this basic valuation equation, if we think of the proxy of future profits as being something like, say, return on assets, so gross profits relative to assets, that ends up being a sticky number in the numerator. And if you can buy those companies at a cheaper valuation, you should mechanically expect a higher return. And what you see when you're scouring the globe for companies that fit this profile of being highly productive in terms of generating profits from the assets and also trading at low valuations, what you find is that international markets, especially Europe today, offer a much better bargain in terms of offering a combination of cheap assets that are highly productive. And we can see that in detail as we turn over to the next slide. Okay. So on the next slide, we have an analysis of return on assets for both the market and also for value stocks across three developed markets: Europe, Japan, and North America. As a robustness check, we measure return on assets two ways. First, in terms of gross profits to assets, which you can see on the left, and then EBITDA relative to assets, which you can see on the right. And both measures of productivity are communicating the same story. The way to read these charts is that the level of return on assets for the overall market is shown in the dots, the dots above each bar, and then each bar shows the return on assets for the value segment, which in this case we've defined value as companies that are trading below book value, so lower than 1 times price to book within each market. So there are a couple of important points to draw out from this analysis. First and foremost, we see that value companies everywhere have lower return on assets than the overall market. So in terms of gross profitability, you can see that across the different regions, for the market, gross profits to assets, averages somewhere close to 20% in North America to 25% in international markets. Whereas for the value stocks within those segments, those measures of productivity are lower. Same thing for EBITDA to assets. But what you find is that in international markets, return on assets is significantly higher than the US. So as we look at Europe, for example, in terms of gross profit to assets, the value stocks in Europe are offering a gross profit to assets of close to 19%, compared to 13% in North America. So that's essentially 1.5 times higher in Europe compared to North America. The difference is even more stark when we measure asset productivity in terms of EBITDA to assets. So in Europe, you're getting a return on assets of 6.4% amongst your value segment, whereas in North America it's close to 2%. So essentially getting 3 times higher return on assets within your value segment in Europe relative to North America. And this is quite an interesting finding, and there are a couple of reasons for it. One is that in North America, the market as overall has just become so expensive that the companies that are trading below book value tend to skew more towards junkier companies in North America, because essentially this base effect where the overall market is trading at 4 times price to book. Whereas in international markets, like, so take Europe, the market trades at 2 times price to book, so half the level of the North American market. And also, as we'll see later on, valuations have essentially stagnated in Europe since the dark days of COVID. So what you find is that there are more quality companies that have essentially fallen into and remained in the value segment, which in this case we've marked as below 1 times price to book. So a good way to think about it is that the value segment in international markets is significantly higher quality than the value segment within North America. So on this slide, we measure the spread in valuations in Europe since 1975. And the way that this is calculated is by defining the value segment as the cheapest 30% of stocks in terms of price to book in each year, compared to the most expensive 30% of companies in Europe in each year since 1975. So the way to read this is as the line gets lower, essentially value is getting cheaper and cheaper relative to growth. And what you find is that in recent years, so starting with the bottom right corner of this chart, in the most recent years, essentially since 2021 after COVID, we currently have the widest valuation spread in recorded history since this data became available from Farmer and French in 1975. Today, essentially, the spread between value and growth in Europe is wider than two standard deviations from its historical average. And that has been the case since 2021. So valuations within the cheaper segment have essentially remained stagnant since the dark days of COVID, because in Europe there's been uncertainty first caused by COVID, then by the uncertainty created by the war in Ukraine starting in early 2022, and also the attendant rise in interest rates. So the past 3 years have been essentially a continuous state of uncertainty from a market standpoint, even though underlying fundamentals have been improving over time. So you see essentially a stagnation in valuation multiples. And today, valuation spreads in Europe are more extreme even than what we saw in 2000. So one would expect, through the combination of valuation spreads being so extremely wide relative to their own history, and then also what we just saw earlier in terms of European companies within the value segment having higher quality characteristics, we believe there's a strong case to be made for mean reversion in valuation multiples. And even while people wait for mean reversion, which seems likely just based on the historical experience, even while you continue to wait, the fact that European value companies have higher return on assets means that a decent return can be earned in that segment even without multiple expansion, because these companies have highly productive assets, so they're continuously generating earnings, which can then support returns even while investors wait for mean reversion in the multiples.
Brian, it appears that part of the thesis here is the persistence of productivity, not the persistence of growth. Is that persistence of productivity part and parcel to good capital allocators as leaders? I think in the United States, we sometimes fall victim to the dynamic CEO. Is it just that the good capital allocators wind up having persistent productivity?
Yes, I think that's a large part of it, Keith, in that companies that are prudently allocating capital to buying or investing in productive assets have the most persistence in productivity, and which would make sense logically, right? So if someone already has a good business that's generating earnings and cash flow, they essentially got a choice in terms of how they allocate their free cash flow. Um, One is obviously that they could reinvest in the business in terms of capex, assuming that they can um, uh, generate a sufficient return on investment. And then the other, obviously, would be in terms of paying down debt, um, and which ultimately, over time, frees up more capital over time by reducing the interest burden. And then another option, obviously, would be in terms of acquisitions. What you find is that companies that are highly acquisitive generally tend to have lower returns over time. And I think that's largely because um, it is relatively rare, as you can imagine, to find companies that are um, uh, highly productive. In the same way that it's relatively rare to find not every student in the class is going to be a straight A student, right? So there's always going to be a distribution, right? So if you think about that in terms of companies, there's a segment of companies that are straight A or A minus companies, and those are limited. Whereas if there's a CEO who's highly acquisitive, that CEO is essentially going to be at some point going to end up buying B or B plus companies, or even perhaps worse, and thereby diluting the overall profitability of this empire that he or she is building. So what you find is, I think, whilst companies can be fine doing modest acquisitions, the ones that are most highly acquisitive tend to have the lowest returns, and also tend end up having the least productive assets over time, almost mechanically.
I mean, I think this last slide, Brian, really says it all for me personally. I think back to my career, and actually in 1998, my very first stand-up presentation in front of, I want to say, 300 Morgan Stanley advisors was why international. And I remember being teased in 1999 how wrong I was. And then fast forward 10 years later, how right I was. But everyone had forgotten because I was just a little early. And I bet if you were here in 2020 talking about how cheap these international stocks are, they're still cheap. And I'm wondering, are they still cheap today because maybe the war in Ukraine, or are there other factors that are, is the U.S. just doing that much better? I mean, what's keeping the European markets cheap?
So yeah, great question. So overall, the answer would be, in terms of what's keeping stocks cheap. The answer would be uncertainty, naturally, right? So then the next follow up question would be, okay, what is the biggest source of uncertainty? I think the war in Ukraine is one component of it for sure. So the second component, obviously, is the rise in interest rates, right? So in the US, we found that the economy has generally been um, resilient to the rise in interest rates. And a logical question that people may be asking is the same true for Europe? Um, Interestingly, what you find is that the doomsday scenarios that people had anticipated in 2022, when interest rates started marching up, those haven't those haven't happened yet, right? So if we think back to a year and a half ago, in 2022, people were anticipating that Europe was going to run out of natural gas in the winter. Europe was going to have to ration gas to industries, and by good fortune, through both having a warm winter and also through prudent planning in terms of stockpiling natural gas from alternative sources, Europe got through last winter just fine without having to ration. Um, and that supply chain for natural gas has essentially been has already been set up and is established. So there are basically no articles, news articles today expressing much concern about supply of gas for the next winter. So that's just an example of how there was a doomsday scenario that the market was pricing in 2022 that didn't materialize. So similarly, we could ask, okay, for if people are anticipating some kind of doomsday scenario for as a result of the rise in interest rates, how likely is that to materialize? And ultimately, how is that going to look relative to expectations? So today, the market is basically telling you that things today remain essentially as bad as they were during the depths of COVID, right? So in Europe, the value stocks are on average are trading at 0.8 price to book. In terms of EV to EBITDA, typically, value stocks and deep value stocks are trading around 5 times EBITDA, right, today. And that's the same level where they were trading in 2020. So the market is basically saying that things are as bad now as they were in the depths of COVID before we even had the vaccines.
When I looked at your last chart and you saw that just disparity, that enormous disparity, that disparity can sometimes be made up in not so much positive returns for international, but less horrible returns for international relative to other things. Is that a likely scenario, or do you think it's just going to be maybe bad returns or normalized returns in the United States and very good returns for Europe?
That's an excellent point, Keith. I mean, I think I'll say either scenario is plausible, in that ultimately I think everywhere you should probably, when you're looking at the overall market, returns going forward should be more moderate than what we saw over the past decade, just based on where valuations are today. So in the US, according to various sources, including research affiliates, in the US you can probably expect realistically low single-digit returns going forward. So even then, even with valuation being very expensive in the US today, the expected return is still it's still positive, but most likely in the low single digits. And what we would assume, just based on where valuations are, is that over a long enough period of time, so a decade or more, you should get a positive return in international markets that is higher than the US. So if the US is giving you low single digits, maybe international markets are giving you perhaps high single digits for the overall market. And returns for value should be even higher, because of everything we were talking about, in that value stocks already priced with a high cost of capital, so they face less of a headwind when interest rates are rising. And also value stocks, especially in Europe, are so extremely cheap relative to both the growth end and also relative to their own history, that there's a lot of room for them to run up in terms of multiple expansion. So I would say that I would have the highest if you're aiming for double-digit annualized return, I would have the highest confidence in the international segment, and within that international segment, the value segment. So the value segment within international markets, just based on today's characteristics, should be more likely to deliver a double-digit annualized return over the next decade or so.
I believe the word Verdad, which is your company name, means truth or true in Spanish. Is that correct? Is that where
Yes, that is correct.
okay. Is there a truth maybe that you'd like to share with us about investing, and any last parting words that you'd like to share?
Oh, yeah, that's a really great question. Um, I'll say ultimately, I think um, an important truth that I've learned along the way is that time is the most important ingredient for successful outcomes. Right? You can do all the analysis correctly. You can do all your homework, but generally speaking, at the end of the day, the most important ingredient is hanging on tight and um, and waiting for the reward over time.
Well, what's the beautiful thing
Good
about
advice.
it seems like Value Investing International right now is that you're getting paid 4 to 5%. So while you wait, you're getting paid, right? So that's always a really good thing. So I can't thank you
Indeed,
enough, Brian, for joining us today. And
indeed, exactly.
I really appreciate your time.